What's up, guys? Ron from Rohde Law, and today we're going to talk to you about how to finance truck parking lots. Now, if you follow this channel, welcome back. This is another series of how to invest in truck parking lots, okay? The demand for these products is incredible, and I'm going to show you how it's one of the lowest cost ways to get into commercial real estate and to start investing in industrial land, all right? So, critical element, what is truck parking? Technically, it's an industrial use. It's a subset called industrial outdoor storage. We love it. It's a great asset class. It has multiple exits. Check my other video where I talk about why iOS is such a great asset class. But today, we're going to talk about financing. And in particular, the capital stack is really critical because these assets can be difficult to finance. Now, I'm going to go and assume that you're going to be purchasing with a commercial loan. There are two main loan products that you're going to need to understand what you need for your situation. The first is a construction loan. This is suitable if you have a piece of raw land, this is a vacant piece of land, or something that you need time to get the income up on the property. So with a construction loan, you're going to have time and maybe some additional loan funds beyond just closing on the dirt to perform improvements. This could be gravel, this could be fencing, this could be lighting, this could be gates. All of these things that cost money to create a good truck parking location, you'll have time, maybe 6 to 12 months of an interest-only period where either the interest is accrued and it's deferred, or you'll be making the minimum interest payments every month. And only after that 12-month interest-only period is over, you'll have to be making the full principal and interest payment. That's called the P&I payment, and that's roughly where your payment's going to double. So this gives you a little bit of a break from your reserves, but you need to use that time wisely and be completing your improvements and getting trucks on site and paying you rent so you can afford that mortgage. Now, some of the example terms from the day that I'm recording this, and I'm in Texas, call it a 12-month interest-only period with maybe a 2 or 3 year mini perm. That's considered a mini permanent loan afterwards. But again, it's meant to be a short time period to be less risky for the lender. You're looking at probably a 9 or 10% interest rate. You can back calculate based on your loan what the interest payment is. That will jump probably on a 20 or 25 year amortization schedule. And that there will be certain draws or certain requirements if you're improving a site. If you're just buying a vacant site, you may get away with 3 or 6 months of IO just to get trucks on site if you don't have to do heavy lift on improving the site. Now, let's talk about the other loan, and that's going to be more of a permanent, stabilized, maybe you guys call it a DSCR loan. And roughly what that's going to do is the lender is going to take the current income that the property is producing and back into a calculation of 1.25. What can that property support in terms of a debt payment? And subsequently, how much can they loan solely based on the trailing 12 or maybe trailing 6 months of income minus expenses to produce an NOI. That's a net operating income. This can be one of the harder ways to get enough loan LTV ratio. However, it is useful if you have a property that's already income producing and you want to get an acquisition loan that helps you buy the property, and then maybe you self-fund additional improvements based on the cash flow from the property. But in a DSCR loan, you're looking at probably a term of 5 years. So you've got longer term, fixed rate, which is great in this interest rate volatility. If the rates go down, you can always refinance. And if the rates go up, then you're locked with a fixed rate. Some loans may have a prepayment penalty. So you'll see that quoted as like a PP or maybe a prepay, and that's essentially a penalty. So if the lender gives you a 5-year fixed rate loan for 5 years, they might have a prepayment penalty of 321. That's basically if you refinance in the first year, then you pay a 3% of the outstanding loan balance as a penalty to the lender. If you refinance in the second year, it drops down to 2% of the existing loan balance, and finally 1% in the third year. If you refinance in year 4, that's totally fine. Same in year 5, they're not going to charge you any penalty. You should read your loan documents because there are some exceptions for selling the property, recapitalizing. Anything short of refinancing with a different lender may not trigger that penalty. So On a DSCR or a stabilized loan, you're also looking at 20 years amortization period. Your interest rates right now are going to be lower, probably going to be 1 to 2% lower than the construction loans, which again, it's great if it's a stabilized property, and if you have the opportunity to increase income based on even existing income and acquire it, you have a really great position where your upside is unlimited, but your downside is capped because you have this fixed rate debt and you're not taking on a huge refinancing risk like a construction loan. For both of these loan products, you're going to have to provide a personal guarantee. I think if you're starting off and if you're looking at LTVs in the 75% range, 70, 65, you're going to have to personally guarantee it. Only if you drop down into maybe the 50s could you get non-recourse for this type of product. But I will say that banks are very keen on lending on industrial assets right now, and this is a hot product that if the banks are willing to loan, it's going to be on this type of product. The last and possibly the best way to get financing for truck parking is through seller or owner financing. Now, what you're going to do is want to offer as little down payment. However, we're looking in the 10 to 20% range of a down payment. Now, this only works for a parcel that's potentially fully paid off. If you're doing seller financing and they have existing debt, you're going to have to cover that debt. I don't want to go into a subject to. There's too much risk and it's too complicated for a commercial asset like this. So therefore, we don't recommend doing subject to an existing mortgage. However, you can do seller financing. Today, you should be getting rates between the 5 to 6% range, and 25 or 30-year amortization is very common. The key flexibility is certainty of close. When you have seller financing, you're not relying on a third-party bank to give you money. You have the seller, there's no appraisal fees, there's no environmental, there's no legal fees for the lender, there's no origination. So you're going to be looking at saving 1 to 2% of the loan amount just in fees alone. So you might be willing to pay more on the purchase price slightly if you can do seller financing. So you should always be prepared that depending on what type of debt is on the property, you might want to offer seller financing. But again, have it as two separate ways. You're willing to possibly pay more if the cash flow is there with seller financing and the cash on cash is there. And you're willing to pay less if you have to pay the seller in cash from a third-party lender. That's it for this video. I hope it's useful. Remember, the two major ways to get truck parking financing is a construction loan or a stabilized loan. Smash that like button and we'll see you next time.